Tonight we are offering the best of technical analysis, a one-stop shop of everything you need to know to augment your investing with the help of some of the best chartists in the land. Now, let's work on something that's been the province of the best chart work on the show, spotting bottoms for best entry points and examining ceilings for the best places to exit or sell. When you pick individual stocks, you are betting from the moment you buy them that they're going to go higher. I know it's a pretty simple concept, but how often do you do solid fundamental work on a company and try to figure out whether it's the right thing, the right decision to pull the trigger because your homework is finished? And then, well, it just turned out to be a terrible time, and you're buying oblivious to the stock. Hey, my homework's done. Let's go buy. Maybe it's not the right moment. After all of the work I've done on the off-the-chart segments, I now say you're being short-sighted if you don't check out how the stock looks technically after you've done all that homework. But before you put the buy order in, it's not just the right time since you're done the homework. In fact, I would consider looking at the chart of the stock as you like as part of the homework. Get that in your head. Get it ingrained into your thinking. Sometimes finding bottoms after long declines can be incredibly lucrative. Like a good example, let's go back to the bottom of 2009. Now, I had a sense that the decline's velocity was lessening. I had already heard the late, great Mark Haynes make his famous Haynes bottom call based on his innate feeling. I know that my friend Doug Cass, who writes with me at Real Money Pro, that's part of the Street.com family, sometimes noted as being an aggressive bear, had actually turned pronouncedly positive. He was saying we were at a generational bottom. But I was still skittish about picking any individual stock to recommend to you. So I was looking for a situation that seemed about as bulletproof as I could find. I came up with AT&T, the phone company. It had so much going for it. You got to go back in the Wayback Machine here, but it was included a smashing rollout of the Apple iPhone, which was going to produce record profits as AT&T took business from its Apple-less competitors, had an outsized dividend one that yielded 6.2% at that moment. The yield was much higher than just about any stock in the Dow. The dividend was safely backed by AT&T's humongous cash flow. Still, though, the stock kept plunging every time I thought it might have firm footing. In other words, I had done my research, thought it was time to buy. No, check the chart. So I waited. I waited for a few days where the stock seemed to stabilize and decided that at last the level might be right and the stock could hold. In dicey moments like these, it's best to check with the chartist. So I did. I actually brought in four chartists. Amazingly, they all agreed that T had found a strong foundation and was definitely worth considering for an investment. Remember, they didn't care at all about the fundamentals. So take a look at what attracted them. Take a look at this chart. First, all four technicians agreed that AT&T had established what is known as a climax low at 21, back in the tsunami of selling that was this period, okay? You just have to understand that we are just at one of these moments that was just so hideous. You can see the big lift in stock, and then, well, let's just state, I don't want to give away the story. That's where lots of sellers had capitulated. This is where they capitulated right here. But buyers had started to step up to create a base, okay? See the extended base or floor at the stock at that level. They arrived at that judgment by looking at where the volume, the sum of all the transactions during that period, had expanded to a level far in excess of a normal period's trading. So you can see there's a normal period's trading, then boom, take a look at that, right? That's a sign that the sellers had exhausted themselves. The volume levels, according to technicians, showed that most of the big portfolio managers who wanted out of the stock, they had fled it by now. At the same time, buyers had stepped up to meet the supply with a concomitant level of demand. Think of it like this. Until you got the climax, there were so many more sellers than buyers at each level that they knocked the stock down with their own selling. As long as sellers overwhelm buyers with their dumping, no base can form. Bad time to buy. A climax is a sign that those potential sellers who have been holding on for some time are finally giving up en masse. Big give up. Remember, technicians don't care why that might be the case. They're just monitoring price and volume. When they see that volume gets larger or expands, but the stock doesn't go down, that means at last the stock has found its floor, so it's now time to buy. It's safe. That's where the buyers are at last equal to the sellers in their power to determine the direction of the stock, and that's a form of equilibrium. It's finally upon us. Okay, that's the base ATT, but how about the advance? That's going to happen when a stock takes out resistance overhead, okay? To examine the possibilities of a stock, the technicians don't just look at the closing price and the graph that price against the previous days or week close. They don't just look and say, oh, that looks good, that looks bad. No, that's not helpful because it doesn't yield a true picture of the stock's trajectory. Instead, technicians use what is known as a moving average to better represent the action in a stock's price movements. A moving average is formed by taking the closing prices of a stock over a period of time. and then adding those prices up, and then dividing those prices by the days in a particular measured period. Tend not to talk about this and off the charts, but we're doing everything tonight. I'm breaking it down. For example, you can measure a moving average over, say, a 10-day period by adding up 10 days worth of closing prices and by dividing the sum by 10, plotting the number on a graph. Each subsequent day, you add in the new close, and you drop off the earliest price to get the sum of a new 10-day measuring period. The 4 technicians I check in with for ATT, they all choose to use a longer-term view. They selected a 200-day moving average. They noticed that even though ATT had most certainly found a floor at the $21 level that the stock had repeatedly bounced off of, it kept failing, meaning couldn't get through, failing to move up above the 200-day moving average. They had all plotted it. They all done the same amount of work. That's what they looked at. And that created what looked to be a ceiling. See, we had the ceiling, the 200-day moving average. There's nothing you can do. They just felt that every time it got there, the stock was capped. Then at last, ATT cracked through the ceiling of resistance, and that's the 200-day moving average. That was the signal. That was the signal that at last ATT could generate a great trade or an investment. The old roof became a new floor. Here's your new floor, the 200-day. Every time the moving average went above the old roof, it would create the possibility of a new floor. Then the stock would come back and test that floor, and it held. This pattern emboldens buyers as they recognized the stock didn't break that newfound base and instead bounced off it. In other words, it didn't go back to where that climax low was. It held. Looking back at the beautiful bottoming that we see here with ATT, it now seems like child's play, doesn't it? Yeah, of course it was done going down. Yet at that moment, it was anything but easy because at the same time, these technical analysts were saying the bottom is in and it was time to buy. The fundamental analysts, they were scared out of their wits. Not one was valuable to me in helping to call bottom. They were all scared to death right here. Some were even worrying about pension obligations that could cause the dividend to be slashed, something that was way, way wrong. But it scared the heck out of me. Remember how many people are in this stock for the dividend? That base, that floor, gave the stock a launching pad to blast off in an almost straight line into the 30s. It's one of the biggest gains a safe stock could ever give you. So here's the bottom line. When you see this kind of reliable pattern as ATT demonstrated, despite what the fundamental analysts might be saying, you have to use the discipline that these technicians give you to pull the trigger and take advantage of a fabulous buying opportunity that might otherwise be overlooked after the market takes a real shellacking. Never took it out. And then way up. After the break, I'll try to make it more money.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.